Hey guys, Mike here. So obviously another roller coaster day in the market. Like I said, just make sure you buckle up, click every day, because the only thing consistent with this market is volatility, swings all over the place. Okay, and there's a lot of news we're gonna go over. I mean, a lot of news. Obviously, you got J.P. Morgan's Jamie Dimon coming out saying some stuff. The chart, you're seeing new lows you hadn't seen in like 2 years. Big day tomorrow, and then I'm gonna tell you exactly, what happens when the Fed tightens like they do, just in case you're unaware, and then what to be expecting going through this bear market, because shockingly, it won't end until, usually, 100% of the time, until they stop raising rates at least. But with inflation being as high as it is, that might not be the case either, okay? And so it is interesting to see, though, that we're not the only one with a labor market issue, because I did see this come out yesterday, and it says UK jobless rate hits a new low in June and August at 3.5%. So exactly where we are at. And it goes on to say the number of employed people slipped by 109,000 during the same period. In September, the UK economy added 69,000 jobs, with payroll employees reaching a record 29.7 million. So I guess they have a hot labor market, it seems, over there. And, of course, their pension funds are still under pressure, so the Bank of England is having to intervene even more and actually expand what they're purchasing now. And this is the kind of stuff you see happen with the rates going up. Stuff breaks, and this is what's breaking over there. And I think this is one of the many reasons you're seeing Jamie Dimon come out and do an interview, and he's saying we're going, we could absolutely head a lot lower. Matter of fact, he's calling for an easy 20% move down, which technically I can absolutely see that as well. And still, you're waiting on this capitulation moment. I still say, and I don't know what that's going to be. It's going to be something to do with the financial market. It's going to be something what the UK is dealing with. And I mean, I'm going to show you something in a video here. It won't be today, probably tomorrow. But of what the first step's going to be. I think before we see the capitulation moment, it could be a coincidence that it happened every other single time in a bear market. But I'll show you that as well. And it happened about on average 5 months after this event occurred. And so, and matter of fact, all of them were very scary. It was like between 140 and 170 days exactly on every bear market. It's kind of crazy. And so I'll show you that tomorrow. But obviously, what's happening, you see here, guys, technically, we're just setting, new low after new low, right, with these red days. So the NASDAQ 100, obviously, you hadn't seen this low for 2 years now. So it goes back to September. So it is setting this new low. More importantly, it is reaching this trend line here, which is trying to hold on to. And this is just one of those trend lines you can see it's been respected for a long time. Going back to 2013, it has bounced off of it many times, been rejected off of it many times. And then if we look, I think a lot of people are calling for it to go a lot lower, which seems definitely going to be the case. And so we draw this trend line out. This is where the 2020 and the 2018 market crashes actually stopped at. And so when we look at it, it actually kind of lines up with what Jamie Dimon was talking about. I think a lot of us expect this, so it don't really matter as long as they're actually going through with all the tightening and rolling off the balance sheet. But again, and when that capitulation moment happens, and it most likely will, there's 20% right there. So it could be a coincidence. That's what he's calling for, but that's definitely what you can see. And then you see on the Qs, triple Qs here, obviously beat the June lows. You got to go all the way back to September of 2020 as well before we reach this level. And so the whole NASDAQ is under pressure. Tech is still being hammered. When you don't think it's going any lower, it does. And what's funny, though, if you look at the Russell 2000 IWM here, it is not breaking its June lows yet, right? The Russell loves to trade in these windows here. It gets in there and it'll just consolidate in a range forever and a day for months and months, right? And so it has not broke its lows yet. But when we look at it, I mean, you can see what I'm talking about. And I say, like, this right here, oh my goodness. I know swing traders had a field day with this one. But like almost the entire 2021, it just sat here, in this range right there, going back and forth, right? And so if we go back farther, you'll see it multiple other times. And really, I think it's because small caps got absolutely crushed. I mean, some of them were down 90, 95%, and so they tend to trickle down a little lower now, right? Because they've just been gutted. And so it's a little bit easier for them to trade in these windows right now. The S&P obviously still have stocks, above their 52, or still setting new 52-week highs and stuff, which is kind of crazy. But and then trading above certain moving averages in certain sectors. And so, the big question is, what's the market doing, right? Is it selling off? Because there's not really any major shocking news coming out, right? But is it selling off to get ready for the PPI tomorrow? And then Thursday, the CPI, is that what we're doing here? Trying to go ahead and wait for a bad report. Because when you think about it, I mean, seriously, is there anything in those reports we're going to be shocked about? You know, inflation's high. Yep, sure is. Still high. You know, and so I don't think there's anything that should shock the market. You know, we've been through a lot of these, and we've been through some pretty shocking CPI reports that caught a lot of people off guard. But just so you know what we're up against, and I'll give this to the members in the morning when it comes out. But, you know, you can see year over year, here's what we're looking for, right? You can kind of see where we've come from. We've actually come down the last few months, right? After being up and not exactly hitting projections. You can see previous there from August, or July, 11.3%. Forecast of 10.4 for August. Came in at 9.8, right? So it came down. Then that shifts over. The forecast is 8.8 for last month. Came in 8.7. Okay, and so now we're forecasting 8.4. So the projections, you know, we've been coming in under slightly, which is a good thing. Then when we go to month over month, which is the most important to me, you can see in last month we came in right at projections, and then the month before that was very disappointing. That was a catastrophe, honestly. And so that was bad, but then the month before that was actually good. And so the month over month projections haven't quite been. And please hit that like, subscribe button, and share the video if you get anything out of this, guys. I really appreciate it. On point, but those are the most important to me, at least. And so that's something to, you know, pay attention to for sure tomorrow. I can't imagine it's going to move markets unless it comes off way out somewhere. I mean, but, you know, we'll have to see on that. We'll get a lot more on this when we talk about, like, when we hear the earnings call and things like that that are, you know, going to be kicking up here starting really next week. You'll get more of that kind of data coming out. But when you look at it, you know, this is what happens if you've never seen this. When the Fed continues to tighten, let me tell you, this is why they always break something, right? I mean, you go through here, and you can just look at this yourself, pause the video if you want to. I'm not going to go too far back, but you can see right there the 87 stock market crash, you have the 90 S&L crisis, you have the 2000 tech bubble. They're actually tightening into when these things happen, right? 07 they're tightening, 07 subprime crisis. And this is what they do. You know, they usually do tighten. They usually break it. There's only supposed to have been one soft landing, if you want to call it that. And I think it was in 97 or something. But, you know, every other time they tighten up, boom, we hit something. Bad happens in the credit market, the debt market, the mortgage industry, whatever it is. Something ends up going wrong, right? And you're seeing that in Europe. It's already starting there. You'll start seeing it in other places too. There's already been rumors in other places. Good thing is our banks are highly capitalized, so, you know, we'll see what goes on there. Like I said, my bet's on the bond market, some municipality going bankrupt, maybe a hedge fund, or not a hedge fund, but a pension fund gets way overextended, because you'd be shocked how big some of these pension funds are in America. It's incredible. Multi-trillions of dollars, right, in these pension funds. But one thing I found funny, and I was going this for you guys, is to kind of give you an idea of what we're probably looking at here. Could be worse, but I like to keep it realistic. This is the S&P 500 during the last balloon that we did, right? This is after the 87 crash, and obviously we started moving up, and then you had this huge asset bubble happening right here, right there. That was the big, and then all of a sudden, boom, tech crash, right? And it comes down, and there it comes right down to the trend line, right? If you draw a trend line where it connects to 1,000 different points, it hits it, no problem, okay? And then if you come down to the bottom where we're at now, you can see after the 08 crash, what do you see? Looks very similar, right? It just kind of, there's a steady little march up there. You can see right there. You know, it's bouncing off of it. It's getting rejected, all that stuff, all the way up through all these different years, right? And then, of course, what happens? Everything starts to get really inflated after 2020. Here comes the bubble. Oh, my God. And then it pops. And so you can see how far we're above that trend line right there. If that is the bottom of the finish line, it's almost where the COVID crash was. And so, yeah, I mean, that could be what we're looking at, assuming all the stuff happens that we think is going to happen. Nobody's Nostradamus around here. But, yeah, I mean, to me, everything you look at says, yeah, but no doubt we got farther to fall. I mean, oil hadn't even crashed yet. So, I mean, there's no doubt we have further to fall, you know, over time here, right? That's why I keep telling people, I'm like, if you don't have the capitulation moment, if you don't actually have a recession that's actually taking place, right? Because think about it, now when employment starts to go away, right, and go up, 3.8, 3.9, 4, 4.1, then you start to see a hurt lock. That's when you usually get that capitulation moment, because people are losing their jobs, right? They can't pay the bills. Credit market start to seize up. Debt market become a problem. I mean, that's the kind of stuff you're looking for. I'm just looking at this capitulation moment in America going, where is it? I don't know. Could happen at any moment. Can come out in the news for sure. You know, and that's why I tell people right here, you got to look, guys, and be prepared for this. When you're in a long-term bear market, this is why you don't see me talk about 2018, 2020, 2011, 12, whatever. These short crashes, because this is an extended bear market, right? And I think we're, what, 9 months in? And so when you look at the dot-com bubble bear market, you know, you had 8 months of trading in a window, then it drops down again, then you go for 10 more months like that, and then you go for 11 more months. This is why it wears people down, because you're just getting these ranges where it'll just trade in these ranges for like months, right? You go to 08, what happened? 9 months. You know, end up having a big run up, and it kind of sells down and holds on. Mind you, this is a weekly chart, so don't look like it's long, but these are weeks. Every candle's a week. And then you had 10 months where it ends up finally bottoming out, but it just trades at a max, you know, level right there. And you can see this one, the windows are a lot shorter than the weekly time frames. I didn't even bother putting how many months these are. But you can see one's 4 months, one's 5 months, and now here we go, right? Are we fixing to move down into the next window and start trading sideways? Is that what we're going to do? Is we fill out this downward trending channel, and the odds are, and I'll go into this in more detail tomorrow, if we break the 200 on the weekly, yeah, we sure are. Unless earnings pulls us out somehow, yeah, that's exactly what's going to happen. I mean, how could it not, right? Breaking the 200 weekly is not a bullish thing at all, and it will trigger many algorithms, right? Just like the same way it triggered it when it bounced off the 200. All right, so that's what you got to keep in mind. That's just reality. I'm just showing you, putting that out there to you, you know, and that's just what we got to look forward to. But what's going to show us where we're going? Simple is what? I don't think it's PPI tomorrow. And the Fed minutes, who cares about the Fed minutes? They've been out there running their mouth. I mean, should anything in those minutes be bullish or any more bearish? No, we should already know, right? But it's all about the core CPI Thursday. That's what it's about. I don't think it should be that big a deal because, I mean, guess what? I don't care if it came down or up a little bit. It's still high. It's still way too high, right? And the bad thing about the core CPI, I'll preach this to the day is long, is they're going off old data. That's the problem. They're going off old data. And so, you know, unless it's somehow shockingly you get it and it's just this massive drop, then no. You know, now the market's going to do what it wants to do, right? It absolutely, they're positioning themselves. It is going to do what it wants to do, right? And that's why I'm saying in the comments, let me know what you think. Is it trying to push the market down to prepare for a move back up if numbers come in as projected, right? Or do we just keep selling off, right? Nobody can really answer that. I mean, it's a total guess is what it is. But as far as I'm concerned, I told the members this, all I'm doing is watching that 200 weekly. At the end of Friday, if we're below that 200, come on. I mean, that's not, and you've seen it. It's not a bullish move, but you'll see, and I'll show you this tomorrow in detail, what happens when that happens, okay? I'll show you tomorrow what happens. And so, you know, again, it goes back to when everybody's bearish, what's the market usually do? It goes in the opposite direction sometimes, unless there's like a capitulating moment, okay? Which we have not seen. A lot of people think it's going to be Credit Suisse. See you guys in the comments. Could be. We don't know how much exposure our banks had to that company. I don't know. You know, absolutely could be. And so, you know, but there we are with that. I'll come out with another good video with you tomorrow, and a lot of research I put into that as well. And so I hope you guys have a good one. Hit me in the comments what you think and stuff, and what do you think tomorrow's going to be. Take a guess on what you think PPI is going to be. Is it going to come in higher than people think, lower than people think, or right at expectations, all right? And do you think the market is going to be green or red again? How about that? So anyway, see you guys tomorrow.